It's, I think, the problem with AI, right? If you can replicate. Yeah, and so it'll be, so I have no dog in this race, so I know it's up to you. So, but it's a specific company because the bot can do only one company right now. It's got to be BYD, so he wants to pick a company. So if you decide to do it, let me know, and I will put you in touch with Vasant. I have no idea about the logistics. I know your semester is already looking busy, so I'm not sure you can add something to it. So no pressure, right? So today we're going to actually complete most of the rest of pricing. And I want to revisit some of the things we did last week just to make sure they got nailed down with the start of the class. We talked about PEG ratios. You divide the PE ratio by the growth rate. So we talked about the assumption in PEG ratios that as growth increases, PE increases proportionately. Growth doubles, PE doubles. Growth triples, PE. And we said that's not true. Because when you look at actual value, PE increases less than proportionately. So I want you to think about what this means for PEG ratios, purely on a mechanical basis. If you use PEG ratios to pick companies, which of the groups are you going to be biased against in terms of finding them undervalued? Low growth stocks, high growth stocks, or will there be no bias? So using PEG ratio, dividing PE by the growth. What is it? Should it be low growth or high growth? So PE increases less than proportionally growth rate. You're dividing PE by the growth rate. The higher the growth becomes, the lower the PEG ratio is going to become, right? So if you're looking at PEG ratios, low growth stocks will never be able to compete with high growth stocks. In fact, think about a company that has zero growth rate. Will the company's PE ratio be zero? No, if I told you a company can make $2 a year forever, you will pay a price. There will be a PE ratio. But in the PEG ratio world, the PEG ratio will implode when your growth rate gets to zero because it is assuming that as growth goes to zero, your PE will go to zero. We also talked about EV to EBITDA, and I just want to again clean up, make sure we got this right. So in the numerator, we have market value of equity plus debt minus cash. In the denominator, you have EBITDA. And we talked about the cross-holding effect, right? How that can affect the EV to EBITDA. Let's say you've not been careful. You've just taken equity plus debt minus cash, and your company has minority holdings in other companies. 5%, 10% in another company. Will your company look cheap or expensive on an EV to EBITDA basis if it has minority holdings in other companies?
Would it look cheap because it reduces your EV?
Does it reduce your EV
Well,
though?
It's
minor.
reduce the EV, you subtract more in order to get to the value.
If you clean up for minority holdings, obviously you're okay. But if you just take equity plus debt minus cash and you're not cleaning up, then you're going to end up with too high a number for your company because there's these holdings in other companies, right? The market knows what you know, what you own, and it's building into the market value. So when you look at EV to EBITDA multiples for family group companies, be very careful. They can look expensive on an EV to EBITDA basis for all the wrong reasons. They could still be expensive, but part of this is the cleaning up.
Why would it look expensive?
Because your market cap reflects the holdings in other companies, right? So if I take the market value of equity, and let's say you own 15 other companies. Take Microsoft. When I do the market cap for Microsoft, it includes the holding that they have in the OpenAI, which is classified as a minority holding. But the EBITDA, because it's classified as a minority holding, doesn't include any of the income from that holding. So you end up with a high numerator and a denominator that doesn't reflect it. It's an inconsistency issue. So let's put this to bed, go back to where we were, and talk about using EV to sales ratios. If you remember, I came up with this equation again. It looks complex, but it's basically a discounted cash flow model stated as intrinsic measure for the EV to sales ratio. So all you need for that is reinvestment rate, cost of capital, and growth rate, and an operating margin, that companion variable. And I mentioned at the end of class last week, or last session, that I would use this as a vehicle to talk about the value of a brand name. Early in this class, we talked about very generically what the value of a brand name is, right? And if you remember, what did I summarize the value of a brand name as being? What does it allow you to do? but ultimately that doesn't show up in it. So give me a number. So
It allows you to charge more.
it lets you charge a higher price for exactly the same product. Yesterday I bought my generic version of Zyrtec. It cost me half the regular Zyrtec. It's exactly the same drug, but Zyrtec still trades at a premium. So if you think about where it shows up in your valuation, it shows up in your margin, which makes it extremely convenient to focus on EV to sales. So one of the critiques of traditional valuation, and these usually come from either accountants or people who don't understand what intrinsic value is. They say, look, you don't deal with intangibles. You're going to consistently undervalue brand name value companies because you're not bringing brand name into the valuation, at least explicitly. That's actually a lie, and we'll see why it's a lie, because embedded in your numbers are things that the brand name affects. So I'm going to use a very simplistic proxy for the value of a brand name. I'm going to value a company twice, once with the brand name, with all the financials you see from it, and then I'm going to try to value the company again as if it loses the brand name. You're saying, how the heck am I going to do that? I'll give you an example. So about 20 years ago, I got a call from somebody who used to be in this class who works at Coca-Cola. He said, can you come into Atlanta and talk to our management team about the value of our brand name, because we're obsessed about it. I said, okay. So showed up in Atlanta, walked in with a Pepsi in my hand just to throw them off, right? Keep them off balance. And the head honcho, the marketing guy. So it wasn't just finance group, it was a collection of top management. So I started by valuing Coca-Cola with an intrinsic valuation model, reinvestment rate, return on capital, cash flows, growth rate, and it came up with a value of about 80 billion. I finished the valuation, and the head marketing honcho sitting in the front row puts up his hand. And he says, I have a question. I said, what's the question? He said, you missed something very big in this valuation. I said, what did I miss? A beverage, a geography? What? He said, you missed the fact that Coca-Cola is the most valuable brand name in the world. It's a little delusional, but you got to let people live in their delusions. For a while, Coca-Cola was the highest ranked brand name going back in the last century. So I said, okay, what exactly do you want me to do? He said, you should be adding at least a 20% premium to that 80 billion. I said, why? He said, because that's what we do at Coca-Cola, is when we buy companies, brand name companies, we value them and then we add a 20% premium. I said, just because you do stupid things doesn't mean I have to do stupid things as well. He says, don't you think our brand name is value? I said, look, it's probably the only thing in this building of any value, right? Because let's face it, all you people coming in and doing all your stuff, all you can do is damage the brand name. I don't know how many people are involved in the new Coke fiasco from 1986. He said, so why aren't you bringing it in? I said, it's in there. One of my favorite ads goes back about 40 years. It's an ad for a spaghetti sauce, ragu spaghetti sauce. So here's how the ad begins. There's this old Italian lady at a stove stirring, pot. And her son, who's like 45 years old, drops by for dinner. And it looks like he does this repeatedly. Big time loser, clearly. So he comes into the kitchen, and his mom is, and she's surrounded by empty bottles of ragu spaghetti sauce. He says, Mom, what are you doing? She says, I'm making spaghetti sauce. He says, but you used to make it from scratch. To which her response should be, if you didn't drop in every night for dinner, maybe I'd make it from scratch. She says, no, this is good spaghetti sauce. And then he starts listing the ingredients. I'm not very good with spaghetti sauce, so if I put an ingredient that doesn't belong, just take it out. Where's the oregano? It's in there. Where's the tomatoes? It's in there. Where's the cayenne? It's in there. I'm Indian, I throw chili powder into everything. So, every question he has, it's in there. It's in there. If you do good valuation, it should all be in there. So that's what I told him, and he said, I don't believe you. This is why I don't get into arguments with marketing people. But I came prepared. And I got lucky. So I said, let's play a game. Let's suppose tomorrow you woke up with selective amnesia. It wasn't just you, but everybody in the world woke up with selective amnesia. And the only things they didn't recognize were the red can and the words Coca-Cola. Your brand name disappears. You become a generic soda maker. What do you think would happen? You wouldn't be in the front of the supermarket or the grocery store anymore, you'd be in the back. Your prices won't be 50 cents a can, they'll be 11 cents a can. And here's where I got lucky. I found a Canadian company called COTT, C-O-T-T. It makes generic versions of sodas. The reason you've never seen it is you go to any grocery store, you have the local ShopRite soda. Cart makes it, so you won't even see their name. But they have no marketing expenses. They sell directly to grocery stores, sell them for basically nothing. And their margins are 5.29%. They said, look, your margins are 15.57%. Why do you think they're so high? It's not the taste. It's not the nice looking can. It's your brand name. Tomorrow you lose it, your margins are going to look like that of a generic soda maker, 5.28%. And what I did was I revalued Coca-Cola with its revenue base. Basically, I kept the scale the same. So this isn't Coca-Cola versus Cart. It's Coca-Cola versus Coca-Cola with Cart's margins. The value that I got was 15.4 billion. Lower margins have a ripple effect. They create lower returns on capital. Remember, return on capital is margin times sales to capital ratio. Lower cost of capital creates lower return on capital creates lower growth rate. So all the way through. The value that I got is 15.4 billion. Take the difference between those two numbers. That's the value of my brand name. I gave you a $64 billion brand name value. If you don't think it's enough, tell me why. But don't ask me to add 20% to it. So when you think about brand name, it's in there. It's embedded in there. And as long as you know where it is, when somebody says, where is that? You should be able to respond. So if you get a chance, do look at my Birkenstock valuation IPO, because again, this is basically what I tried to do. Is it's in that number. That's the number. And then if people disagree and say it should be higher or low, at least we're having a healthy debate about where it should play out. So each of these multiples, if you think about the process, started by defining the multiple. Then I went through this discounted cash flow model in a little algebra. No. And by the time you get to the fourth or fifth multiple, you're saying you're doing the same thing over and over again. And you're absolutely right. I want this to become second nature for you. When somebody throws a multiple at you, and remember, it's the analyst's job to keep inventing multiples you've never seen before, right? Because you want to be kept off balance. You should be taking that multiple and say, okay, I'll get back to you in about 10 minutes. Your algebra is strong enough, you can get there. You're using enterprise value per user. Let's talk about what drives the enterprise value per user. Because then you can ask the right questions. In fact, let's take enterprise value to user. What do you think drives that value? Why do some companies have much higher value of enterprise value per user and others have lower? I mean, if you take Twitter versus Facebook, the enterprise value to user for Facebook is much higher than the enterprise value to user for Facebook is higher than for Twitter. Or Facebook versus Snapchat. Let's make it Facebook versus Snapchat, because Twitter right now is not publicly traded. Why is the enterprise value to user number higher for Facebook than for Snapchat? How does Facebook make money? Online advertising. So you're saying, if I have 3 times as many users, I should have 3 times as much online advertising. But it's not just the number of users, right? To sell more advertising, you want your users to be on your platform for longer. I mean, this statistic is a little old, but it's not probably that far away from the truth. If this, I think from 2019 or 20, I saw somebody estimated the time that people spent on each platform. The typical Facebook user spends about 57 minutes in the Facebook ecosystem, Facebook, Instagram. Yeah. The typical Twitter user is about 4 to 5 minutes. There are a few who live their entire lives on Twitter, but they're not buying your advertising anyway. They're beyond redemption, right? But basically, if you're asking questions about enterprise value to user, you're not just stopping with how many users do you have. You're asking how intense are users? How long do they stay? What kind of wealth level do you have? You're rich. Why does it matter? Because advertising is more lucrative if your users are more wealthy. This is a platform for asking the right questions, for thinking about the variables that matter. And that's what you need to do in pricing, is make sure you can push back when somebody says pay $300 per user or $500 per subscriber. Any questions about the analytical part? So define, describe, analyze. Now let's talk about apply. The essence of pricing is what you want to compare your company to other companies, right? And of course, you run into a basic question. What is a comparable firm? From a discounted cash flow valuation perspective, what is the answer to that? What is a firm? So if I say comparable, and I'm thinking intrinsic value, what does a comparable firm look like? Gandhar, you want to try? What does a comparable firm have to have?
Not sure. Comparable size, industry.
Ultimately, I want things that affect my intrinsic value, right? What affects my intrinsic value? Cash flows, growth, and risk. So in an intrinsic value world, what's comparable to my firm are other companies with similar cash flows, similar growth, and similar risk. I'll also tell you up front that that's not the way comparable is defined in banking or in equity research. Over the last 80 years, the way comparable is defined is tell me what industry you're in, or was NICS code or SIC code. I'll go look at other companies in there. Implicit there is the assumption that chemical companies must look pretty similar in terms of cash flows, growth, and risk, so let's bundle them all together. With chemical companies, I think that's not unreasonable. But let's say your company is an entertainment company, and you pull all entertainment companies off Capital IQ. Are they similar? I mean, you look across the companies, they're wildly divergent. And if I'm valuing Microsoft, I don't even know whether I should be comparing Microsoft to other software companies, because what other software company in the face of the earth is even remotely like Microsoft? Or whether I should be comparing to other companies that dominate their industries, have a market share that's almost impenetrable in terms of other companies coming after it. So the first thing I want to perhaps open the door to is, when you think comparable, it doesn't have to be in your sector. It just has to be companies with similar cash flows, growth, and risk. But I'll also tell you, no matter how hard you try, when you're done, you have that list of 15 companies, there'll be differences between your company and those companies which you have to bridge. Differences in growth, differences in cash flows, differences in risk. So I'll give you the first decision point you're going to read to if you haven't done pricing yet. If you've done pricing, you've already run into this. You picked a company, you're trying to do pricing, you're trying to find a peer group to compare your company to. When you think about picking that peer group, you can either go narrow, try to find other companies just like yours. Similar, same country, same sector, same market cap. So you go, with each criteria you add, your sample size is going to get smaller, right? So you can end up with a small sample of companies very much like yours, or a much larger sample of companies that can be different from yours. Which one's better? Well, it depends on what you plan to do with that peer group. Because here are the 4 things you can do. One is you can try to do direct comparisons. You can compare your company to a company that looks just like it. During the last century, if you looked at auto analysts in the US, there are only 3 companies in their peer group, GM, Ford, and Chrysler, and they would compare them to each other all of the time, sample size of 3. But the difference is they bridge with storytelling. For much of the last century, GM traded at a premium over Ford, and the story was it's got a much broader customer base, much better company. That changed over time, but storytelling. So you do direct comparisons and you try to say that company is very much like yours. There's nothing to control for. Now, the second is if you have differences across companies, which are large enough that you have to expect the pricing to be different, you then say, I think this company should trade at a 20% premium or a 40% premium. Of course, you can already see this is going to be kind of a judgment call, and I'm using the most polite word I can. It's completely subjective, you can make up. So storytelling, which is pretty much what much of sell-side equity research is. You see a company, you see the 20 other companies. NVIDIA trades at a premium over other semiconductor companies, but that's okay. Why? Because it has AI and has growth, and then you move on. The third is you try to modify the multiple for whatever you think the differences are. Hey, why do you think people use PEG ratios, right? You have differences in growth. You say, I bring the growth into my multiple. I don't have to worry about it anymore. Not quite true, but at least you can fool yourself into that. The fourth, and I think this is the least used but perhaps the most productive way of controlling for differences, is bring in statistical tools, which is basically why you see multiple regressions play out over and over again. And this is where, my multiple regression, just the first step. If you want to make this really good, statistically you know that you can modify these regressions, you can make them more powerful. I'm at least opening the door. So here's what I'm going to try. I'm going to take a few pricings, and you can see this play out. So here's my first example from way back 2008 or 9. I pulled up a bunch of beverage companies. So there's the list. I computed their trailing PE ratios for all of them. So they're all US companies. The earnings per share are computed using the same accounting standards. At least I've met that first level test. And I've also given you expected growth and standard deviation in stock prices. Remember, in pricing, there is no right way to think about risk. I can give you different proxies. So I'm going to play the role of a sell-side equity research analyst here, and I'm going to put out a buy recommendation on 3 of these companies. The 3 companies I'm going to pick are Andre's Wine. Do you know what they make?
No.
Champagne that's so cheap you get a headache watching the ads. They come up only during Christmas, right? Just before Christmas you'll see the ad. They're cheap champagne, really, really cheap champagne.
Probably
Let's
cheap
face it, on Saturday and Sunday, that bottomless mimosa you're drinking, that's coming from Andre's Champagne. Now, if you think brut champagne, that's what they're using. No, it's bottomless, right? The cheapest champagne you can get. Andre's Champagne is ready to fill in the void. So the second is Todd Hunter. I don't even know what beverage they produce, but presumably they're a beverage company. And the third is Hanson Natural. And I've seen, it's a soda like any other, but you see why I picked those 3? They have the lowest PE ratios. 3 companies with PE. So you know enough about pricing now to push me on it. On 2 of those companies, why might the PE be low? That I've kind of given you the kind of information where you can push back. Their growth is the lowest, right? So if you look at the growth, 3.5%, 3%, 2 low growth companies. With Hanson Natural, their growth looks okay, but what's the catch? They have the highest risk. So I'm not saying this, and this is the problem with storytelling, is you can talk yourself into a corner. On the one hand and the other hand, on the one hand, these stocks look cheap, but on the other hand, they're either low growth or high risk. Where do I go from there? I have no idea. But if you have prior biases, you want to convince me that they're cheap or expensive, you can do it. Storytelling is kind of almost designed to get your biases confirmed, right? Because you can make your story tell you whatever you want. So let's talk about statistically how you can control for differences. This example is almost 30 years old. I've kind of kept it because I like it so much. Until the late 80s, perhaps early 90s, outside of the US, telecom companies are almost entirely government-owned around the world. Then you had a lot of privatizations, and many of these companies went public, and they had ADRs listed in the US. The nice thing about ADRs is they now have to follow GAAP requirements, so the earnings per share, at least in theory, should be comparable. So those are the PE ratios for the ADRs that were listed at the time that I did this analysis. Again, I'm going to play the role of naive analyst and say, hey, you know what, Telebrás and Indosat. Indosat is the Indonesian satellite company. And the late 90s, Indonesia was a really emerging market. It had come off a huge crisis in 96. Telebrás, of course, at that time was the Brazilian telecom company. Now it's been broken up into 6 or 7, but it was the monopoly. They look cheap. Okay? One concern you can see, at that time at least they had low growth in earnings, so that's one worry. What's the other?
Inflation.
Inflation, but these are all stated in dollar numbers, so maybe but these are ADRs from different parts of the world, right? You've got the Danish telecom and you've got the Brazilian telecom. There's an emerging market component here that should make them riskier. That shows up as higher inflation, currency. So there are 2 things that worry you, right? Low growth and high risk. Now, you can talk ourselves into a corner. So here's what I tried instead. I decided to pull up my statistics textbook again. My dependent variable is PE. And for my independent variables, I chose 2. One was the expected growth rate from the previous page. And the second was a dummy variable. You know what a dummy variable is? It takes on a value of either 0 or 1. It's a great way of capturing when you have something that's in some firms but not in others. I put my countries into developed market and emerging market buckets. It's kind of a bludgeon, right? Because I could have used a country risk score or something to get more variation. But here I decided to keep things simple. I get an R squared that I'm okay with, 66%. I think statistics classes ruin you for life because everything in statistics classes is R squares of 90, 95%, which means you're testing something not worth testing. Like, is there a correlation between how much you drink and what your GPA is? Yes. Okay. And if you're wondering which direction, don't wonder too long. I mean, it'll show up sooner or later. Is there a correlation between how much you eat and how much you weigh? Of course. Anything worth testing will never have an R squared of 90%, right? That's too much of a slam. 66% is about as good as it's going to get in markets. But here's the interesting part. First, there's a constant or an intercept. What does that tell me? Basically, it's my starting point. It tells you something about the overall pricing in the sector. If the sector's pricing is high, the constant is going to be high, so it's your starting point. Second, on the growth rate, 121.22. Give me an intuitive, at least explanation of what that tells me about the link between PE and growth. Every 1% increase in the growth rate?
It's 0.66% increase in.
Why 0.66?
Sorry,
It's 1 point. So every 1% increase in the. So if your company has a 5% growth rate higher than mine, your PE ratio should be roughly 6 higher than mine, 5 times 1.21. You see, why is it 121 and not 1.21? Because in Excel, this is something you're going to notice very quickly. You enter numbers in percentages. It reads it as a decimal. As long as you know what you've entered, you're going to be okay. What's this minus 13.85 on my dummy variable? Lambert, how would I read that?
So if you're in the emerging market, it would be like lower.
I have two telecom companies. One is developed market, the other is an emerging market telecom company, exactly the same growth rate. The emerging market telecom company has a PE ratio 13.85 lower. Remember we talked about country risk premiums? This is the market's judgment on how much country risk mattered at the time that I ran this. I'm not doing any ratings, default spread dances. I'm just letting the market tell me. So basically, here's what I can do. You remember I told you I thought Telebrás looked cheap because it traded at 8.9 times earnings. I plugged in Telebrás's growth rate, which is 7.5%. The fact that it's an emerging market company into the dummy variable, I get a predicted PE of 8.35. At 8.9 times earnings, Telebrás is actually overvalued, not undervalued, or overpriced, not underpriced, given how other telecom companies are being priced. So open up your statistics workbook, be creative. Right? Be creative about how you think about risk and growth and cash flows. You're no longer in the intrinsic value world where there is a definition that's right and a definition that's wrong. No, bring it in. So let's try a third example. These were European banks in 2010. Most of these banks, I can't even pronounce the name, forget about having heard of. So there's the list. There's the price to book ratio in the first column, and return on equity and standard deviation in stock prices in the next two. Again, if I pick purely based on price to book, this is a no-brainer, right? Bayerishi, Hippo, whatever, is 0.8 times book value. But it also has a negative return equity. So here's what the eyeballing part of pricing comes in. I want a low price to book, right? I want a high return equity. And on standard deviation, I want a low standard deviation. You're saying low, high relative to what? Statistics, how do we decide low or high? We look at the median and we say if something is below the median, it's low. So here's what I did. I basically took the median price to book ratio, the median return equity, and the median standard deviation. And I looked for stocks that traded at price to book ratios below the median while having returns on equity higher than the median and a standard deviation lower than the median. Kind of very simplistic. I have some bad news. None of the stocks met all three criteria. I got 2 out of 3, but not 3 out of 3. Am I surprised? No, because that would be a slam dunk. But that's the pricing process in eyeballing. You look at the numbers. But you can very quickly get dizzy eyeballing, because what if I gave you 80 companies? How much can you keep eyeballing? So the second thing I tried was I said, okay, let me run a regression, because this is going to be something I can run even with the largest sample. And I'll start with the good news first, which is When I ran this regression, the coefficients all had the right sign. Again, don't expect that to always happen because the data is the data. Okay. Every 1% increase in return equity increases my price to book ratio by 0.0363. So basically, higher return equity banks have higher price to book. And higher standard deviation in stock prices goes with lower price to book ratios. The R squared, 79%. So a lot of the variation in this sector can be explained. Okay. Again, after I ran this, I said maybe I should have thought about a different measure of risk than standard deviation stock price. With a bank, think about what you worry about: risky banks versus safe banks. What is if you had to pick one ratio as your proxy for risk in a bank, what might that ratio be? One is you could look bad loans, maybe, if that's what you're worried about. But if you think in terms of regulatory capital, it's actually public information. You can look for, so I could have taken that standard deviation stock prices and replaced with tier 1 capital ratios, and then done this entire analysis around return equity and tier 1 capital ratios. In 2010, I did not have access to Capital IQ. I could not have done it. Today, if I were pricing banks, I'd probably bring that in as a measure of risk in the bank. Well-capitalized banks are less risky than undercapitalized banks. The advantage, of course, with the regression is I can now get you predicted price-to-book ratios for each of the banks. And that difference in the actual and the predicted becomes a measure of how under or overpriced the bank is. Again, I'm using statistics as a tool to capture the effects of return equity and risk and bring them into my predicted values. Any questions on that example? Now let's expand this. Right? Once you can control for differences and growth and risk, the need to stay sector focused kind of goes away, right? The reason we say sector focused is because we can't control for difference in growth and risk. We're hoping and praying that banks are all similar to each other. But if I can control for growth and risk, why can't I compare companies across sectors? And that's what I tried. In this graph, basically, I took price to book and return equity of the 100 largest market cap stocks in 2010. I'll give you the 2024 update. Because this is something I do at the start of the area because it's kind of easy to do, very quick, and it's actually it can give you some very intriguing results if you're looking for a company that might be interesting. So in 2010, I took every stock, so each of this is a scatter plot, price to book versus return equity of that bank. So it should be 100 points if you don't believe me. What are these lines that I've fit through? What's this middle line, you think? That's just a regression line, best fit line. In Excel, when you run a scatter plot, it'll actually allow you to fit a best fit line. If you have a statistics package, it's actually very easy to do. What do you think these outside lines are?
So like standard deviation.
It's really a 90, in fact, in most statistics packages, you can draw these lines, basically based on the standard. So what does that mean? All these points that fall between these two lines, statistically I cannot reject the likelihood that they are fairly priced. Am I surprised that so many fall between the lines? Not at all. These are the 100 largest market cap stocks. You're not going to sign. But there are some intriguing variations. But before you take your, this was 2010, before you took your money and put these stocks, as I list them, start thinking about whether there might be something that's missing that can explain why they are where they are. There are 3 companies below the line. First, which are the underpriced and which are the overpriced? Where in the line? Where would I find them in the graph? Yes?
Well, the overpriced ones would be the ones to the top.
Above the line will be the overpriced. So I have Google, Infosys, and Gilead. What do you think? What do you think they share in common? They're very different businesses, right? They were higher growth companies. And because I'm not capturing growth, they're looking overpriced because I'm just looking at price to book versus return equity. I'm missing the growth dimension. And if you look below the line, I have ExxonMobil, ConocoPhillips, and Nokia. 2 of the 3 were oil companies, and that should set off your radar because when you see a lot of companies from the same sector show up as underpriced, it might be something going on in the sector. oil prices had risen and that had pushed down, and that had basically affected their returns in equity. Returns in equity had gone up, but markets were saying it can go away. So it sounds like I'm talking myself out of it, but at least in 2010, if you ask me, is there something I should be doing with this? My answer is, not really, because even the overpriced and the underpriced, I can come up with a good reason why they are. Okay. But let's say I wanted to bring in growth. I hate these three-dimensional graphs because they always make me dizzy. Normally when you run scatter plots, you do two dimensions, right? Price to book, return equity, but almost every statistics package, including Excel, allows you to do a three-dimensional graph. So here's the question I'm going to ask you. Think of this as a cardboard box. Which corner of the box are my cheap stocks in? First, you want low price to book or high? So you want low price to book, high return equity or low return equity? You want high return equity, low growth or high growth? So basically, you want stocks somewhere in there, right? Basically, you want low price to book, high return equity. So that's where you're looking. I have some bad news. There's nothing there. The closest I get is TWX, Time Warner. And remember, closest is still good. So that is the most underpriced. If you go to the other extreme, you have high price to book, low return equity, and low growth. That's the corner which is my most overpriced. UPS looks like it's the most overpriced stock. That brings in growth. You're saying, but risk is a problem too. Well, you can do price to book, return equity, and beta, or some proxy for risk, and you can do the same thing. You can say, can't I bring in all four? I have some bad news. Four-dimensional graphs. Some programs claim to do four-dimensional, but they actually do three-dimensional, but they will actually put it on a matrix where the other it just look at it and say, I have no idea what to do with these. I know pictures are good because you can see them. Even the two-dimensional graph, once you start to go 3 or 4, you have no choice but to open up your traditional statistical tools. With a regression, how many variables can you have? You can have as many as you want. So here I took the price to book, ran it against beta, growth, and return equity. Turns out that beta didn't matter here. So if I were running this regression, I would rerun it again with beta not there. In general, when you run regressions and something is not statistically significant, it's better to take it out than leave it in, because leaving it in just adds noise to your prediction. And with beta and growth and return equity, I'm getting the right direction. I can use that to price every single one of my 100 stocks, get a predicted price. You can be a one-person hedge fund, right? You can do this for 5,000. And when you're quant strategies basically, that's all they're doing. They're not doing intrinsic valuation. They're doing pricing. They're doing it across large data sets. They're bringing in far more powerful statistical tools, but they're doing an extension of what we're doing here of saying, given how the market is pricing everything else, what looks cheap and what looks expensive. Any questions on that example? So I decided to update this at the start of this year. Take it for what it's worth. But I ran this 100 largest market cap stocks in the US at the start of 2024. There are two outliers here, right? What looks like it's incredibly cheap? Verizon looks like it's just hanging out there. And I took a look at Verizon over the last 4 years, and basically, you look at its income, it's declined, its book value of equity has doubled over the period because of acquisitions it's done. The market's looking at it and saying, you know what, there's something going on. The price reflects it. So again, I'm not trying to talk it, but often people say, well, I have to do an intrinsic valuation. How can I decide? I want to find something that's cheap, even before you start. It seems like you're putting the cart before the horse, but I can give you a way in which you're more likely to find undervaluation because you want to act on your valuation. Take the scatter plot, pick the companies that fall below the line, do an intrinsic value of each of them, check out the news stories. 9 out of 10, you're going to knock off the list saying, there's some good reason why it looks cheap. But maybe that 1 out of 10 that you do the intrinsic valuation on. If you go above the line, Eli Lilly is just out there, a class of its own. Eli Lilly has tripled over the last 3 years. Why? It's a Weight Watchers drugs. It's among the traditional pharma companies. You look at the top 10 weight loss drugs now, I think 4 are Eli Lilly drugs. They didn't get on as quickly as Novo Nordisk, but remember, Novo Nordisk got on accidentally. Eli Lilly has actually worked. So it's the weight loss that's, so just like AI is pushing NVIDIA out there, weight loss is pushing Eli Lilly out there.
3 standard deviations? Or
That's 2 standard deviations, yeah. So basically you can see so in fact there are quite a few stocks that are above the 2 standard deviation line, just barely, but CVX, Duke, One of the interesting things was CVX is Chevron, oil company. And the other side, you have ConocoPhillips and ExxonMobil. It's actually, that's interesting when you get one oil company look overpriced, the other go. You see what I meant about this being a good basis for a hedge fund? If you run a hedge fund, what would you do? You'd buy ExxonMobil and sell short in CVX and then say, please God, let everything move to the regression line. I don't know whether God understands regression lines, but as they move in, you make money in both directions. It doesn't matter what the market does, in a sense. And that's why these quant strategies have so much attraction, is it's almost market neutral, because you're essentially making money on convergence rather than, am I right about my pricing in the first place?
Why is it that you use 2 standard deviations instead of 3 when it's statistic?
Well, when you do 3, you're basically going to find nothing. Yeah, that's basically it, right? So it's, you can make it because it's more conservative, but nothing will look. So the lines get pushed out to a point. Maybe Eli Lilly will fall beyond the 3rd standard deviation, but it's almost impossible to find. Now, I did this with 100 largest market cap stocks. It's almost, it's almost a given that I'm not going to find that much mispriced. You know what this might make more sense to do it? Is to pick underfollowed stocks, smaller companies, a sector that nobody tracks, and do this on those stocks, because you're more likely then to find a jewel in the rough, something that's been missed by everybody else. But it's actually a very easy strategy to use, at least to do that first screening. Since we're on pricing, let's try a different pricing. So now I am the trucking analyst. Why? Because I got fired as the beverage analyst. Before that, I was the telecom analyst. I get fired and fired, but I keep getting rehired. Right? I use that, the resume. Equity research, I don't mention what my recommendations have done. I was an equity research analyst of long standing. So I'm now the trucking analyst. And this is my trucking sector. I know it's almost impossible to read the numbers, but basically I have enterprise value EBITDA and an EV to EBITDA multiple. So I'm going to skip KLLM because I have no idea who they are, and go to Ryder Systems, widely recognized name. I'm going to pick them because they have a low EV to EBITDA. They're trading at 2.8 times EBITDA, and the sector trades at 5.6 times EBITDA. So ask me the questions with EV to EBITDA. What are some reasons, good reasons why the multiple will be lower?
High risk.
One is, you're going to ask me about the cost of capital. If Ryder Systems got 80% of its revenues from Brazil or in Latin America, you can say, okay, that explains it. It turns out that they're almost all US based in terms of the revenue. So risk is not the issue.
Cash flow growth?
Cash flow growth, they're all boring companies. They all grow at like 3-4% a year.
Reinvestment? How old is
Okay,
the-
reinvestment. Now we're on to something, and here's something about the trucking business that makes them unique. They replace their entire fleet once every few years. Why? Because you get much better discounts if you replace the entire fleet at one go. So reframe the question. Rather than ask me what the reinvestment rate is, where I will tell you what the CapEx was last year, reframe it in terms of what I just said.
How old is their
How
fleet?
old is my fleet? That's exactly the question I asked. And you know what? It's public information. I went in, dug up the numbers, and it turned out that Ryder Systems had the oldest fleet in this group. So you know exactly what's going to happen. You're going to put your money in Ryder. It looks cheap. And a few months later or a few weeks later, you're going to open up to a news story that Ryder Systems has issued $5 billion of new capital to buy trucks, and there goes your EV to EBITDA back to 5.6. The point I'm trying to make is I pulled this off a real equity research report. There was a buy on Ryder Systems, and I said, okay, that's interesting. And then I read through the report looking for, are they asking the right questions? Is the analyst, and not a single question was asked about, what is the, are they riskier? Are they lower growth? What does the reinvest? So that's the point I make about it. I have no problem with pricing, but I do have a problem with laziness in pricing. Now, this is data, these are the questions that need to get asked. And that's how you can tell a good equity research analyst from a bad one. They all price, they all do this comparison, but the good equity research analysts ask the questions at least. And even though you might not like their answers, you can see them trying to say, is this the reason? Is this the reason? Before they conclude that something is cheap. So Rider Systems basically looks cheap because you're missing that reinvestment component. And this is something you might want to think about if you're looking at any companies in the infrastructure business. Because the infrastructure business, often you reinvest first, you make money later. So early in the life cycle of an infrastructure business, their enterprise value is going to be high relative to any EBITDA they make. But as they age, you're going to see them move around. So you might want to control for where companies in the life cycle before you make the judgment of what's cheap and expensive. I know I told you I don't like price to sales ratios, but this example is constructed around price to sales, and I'll try to stay internally consistent. When I used EV to sales, I looked at operating margin, right? If I'm doing price to sales, I'm going to look at net margins. I have to stay consistent. So these are grocery stores, and grocery stores are incredibly boring businesses to look at, right? They have low margins and low growth, but they have lots of sales and it's non-discretionary. So this was in 2007. You know, I looked at grocery stores, and there was one grocery store that had gone public a few years ago that was throwing equity research analysts off because they'd never seen something like this in the grocery business. It was the original Whole Foods. So there is the rest of the grocery business, and there's Whole Foods. Right? So if I look at any kind of pricing, it looks massively overpriced, even after you control for the fact that they have higher margins. So in 2007, you asked me what I thought about Whole Foods, and I've said they have a high price to sales, and even after a control for the fact they have higher margins, they look overpriced. This was 2 years later. Same business. Where the heck is Whole Foods? It's gone all the way from being the most overpriced to the most underpriced. It's a crisis. All of a sudden, people overreact. It's gone from most overpriced to most underpriced. And in 2010, it's back to being overpriced again. So it's there, right there. Basically, and this is something you're going to notice when you see somebody enter a business that is very different from the establishment. It takes a while for people to learn how to price it, right? The typical grocery analyst had never dealt with a company like Whole Foods. They're not tech analysts. They're not used to disruptors. So you're going to find those mistakes show up. Yeah.
So if you did short it based on that and it converged, would you have made?
If I sold at the right time.
Sold.
Right, so I'd have had to buy in 2007, sell in 2009, buy it back. So basically, I'd have to sell it short in 2007, buy it back in 2009, hold it until. So it's a price, but that's the nature of pricing. It's all about timing and getting out. You can't just price and hold.
So you can
because,
watch it, like get closer to that line.
in hindsight, it looks easy, right? And that's the problem. Is at that time, though, whether any of us would have had the courage to do this is a different issue. And then in 2015, I took a look at Whole Foods. Whole Foods was now pretty close to the sector, but now you've got a new player. That's Sprouts, when it first went public. This is the nature of markets. When something new comes into a sector that's very different. We saw this with Tesla. For a long time, analysts struggled, investors struggled with how to price Tesla, because it was not a typical automobile company. They're still working on it. But it takes a while for investors to learn how to price things that are different from the bank. That's bad, right? But it could be good. Because if you think about pricing, what are you looking for? Pricing mistakes. Maybe this is the strategies. If you can invest the resources in learning about the disruptor a little quicker than everybody else, you get a lead time. Before they get around to it, you might actually be able to price these companies better. So if you're looking at a sector, look at a disruptor. I mean, Airbnb in the hospitality business, very different from any hotel company. But yet Booking and Expedia at least as a starting point. But think about companies that have disrupted a business, and you're going to see people struggling to price these companies because they're not sure what the peer group should be, how these companies will evolve over time. So up to now, almost every assessment I've done, I have this regression, and it delivers this nice result of a high R squared. I can use it to make predictions. But I'm going to get you prepared for some of your peer group analyses where you take your company, you try to explain it looking at the traditional variables, price, earnings, growth, risk, and you're going to find that the R squareds are 1%, 2%, 3%. And I know what you're going to do. You're going to email me saying, what should I do? And my answer is going to be, I'll tell you what the answer is. You can't get blood out of a stone. If the data doesn't give you a high R squared, I can't give you an easy way around it. So I'll take you back to an example from early 2000, peak of the dot-com boom. In fact, right after I did that intrinsic valuation of Amazon. Remember the one I showed you where I valued them at 35, the stock was at 84, I concluded they were overvalued. I wanted to price Amazon at that time. So I took Amazon and I put them against other internet stocks. Remember at that time there was this internet stock grouping where you threw an AOL and you threw in, And there's the scatter plot. Let's suppose, forget about statistics, I ask you to have a best fit line through this. This looks like a shotgun blast, right? You know exactly what kind of R squared you're going to get if I run a regression of price to sales against net margins. What kind of R squared do you think you're going to get?
0.
And that's exactly what the statistics package told me. What the hell are you doing running this regression in the first place? Your R squared is 4%. The T statistic is nothing. There is no, in fact, what's scary is the sign on the net margin. If I took this regression too hard and ignore the T statistic, you know what the regression is telling me? The more negative your net margin, the higher your price to sales ratio. Which some internet companies took to heart, right? They said, you lose 1 billion, we can lose 3. We can go from 3 to 7 billion in no time at all. You give us a higher price. But if you're pricing these stocks, this regression is absolutely useless. So I'm going to give you 2 strategies you can adopt if you have this problem in the sector you're in. Here's the first one. Rather than focus on the traditional variables that you explain the multiple, return equity, beta growth, look at what investors might be thinking about in pricing these stocks. Let me go back to the early 2000s. You look at internet stocks, you say, why are some internet stocks more highly priced than others? I'll say 3 hypotheses, and you tell me whether you agree with these. First is higher revenue growth companies should trade at higher price to sales ratios than lower revenue growth companies. You say, why are you looking at revenue growth, not earnings growth? Because you go back to this page, you look at the net margin. There's only one company in this entire group that was making money. They're all money-losing companies. So I focus on revenue growth. High growth companies should have higher price to sales ratios. I would expect the price to sales ratio, though, to get smaller as you scale up. In other words, if you have $1 million in revenues, you can sell at 100 times revenues. But if you have $1 billion in revenues, that's going to become much more difficult to do. So the level of sales matters. The revenue growth matters. But think about your biggest worry with these companies. They're money losing. They're small. They could fail, right? We talked about the failure rate. And you know how young companies, especially in this sector, fail? What happened to them that caused them to fail? They had no debt for the most part.
They can't get any more.
They ran out of cash. In fact, equity research analysts in the late 90s used to have a cash burn measure. How many months of cash do you have on your balance sheet? And it became a rough. If you had a lot of cash, you're more likely to survive. So I threw in how much cash you had as a measure of survival.
The LN is just the revenue.
Because the revenue, it's a purely statistical problem. If you have companies with revenues that are 100,000 and revenues of 10 billion in the same peer group, when you run the regression, the difference in your independent variables is so large that it gets, so the LN just brings the differences down so the regression is more linear. It's really a linearity thing. Yeah. So in this case, the R squared I got was 32%. Am I disappointed? No, I'm delirious that I got an R squared of 32%. If I'm able to explain 32% of what's going on in a sector as crazy as this one, I'm way ahead of the crowd. And the variables, if you look at it, it turns out that the level of revenues didn't matter that much. I could take it out. But growth clearly mattered. Higher growth companies had higher price to sales ratios, and companies with more cash had much higher price to sales ratios. I plugged in Amazon's numbers into that predicted price to sales ratio. I got a predicted price to sales given Amazon's cash holdings, given its revenue growth of 30.4 times revenues. It was actually trading at 25.6 times revenue. So based on my pricing, what am I concluding? It's underpriced. So let's keep the word, it's underpriced. And it was at the same time, it was within 24 hours, my intrinsic valuation, where I concluded that it was overvalued by 60%, 35 versus 84. How can something be both overvalued and underpriced at the same time? Yes?
Everything you're comparing to is overpriced.
I'm answering different questions, right? When I'm saying, oh, it's overvalued, I'm saying, given the business model and the cash flows, this price is too much. But with pricing, what am I saying? Given how the market is pricing other .com stocks, you're cheap. And you know what? At least in hindsight, I've been right on both dimensions, because what happened over the next year? The price went from $84 down to $11, so they undervalued. But it went down only 85%. You say, what do you mean only 85%? You know what happened to the typical .com stock? It was down 96%. The nature of pricing is you're making a judgment against the peer group. So if the entire peer group is overpriced, you can be right, but being right means you lost less money than other people investing in similar stocks. So that's why I have this obsessive thing about valuation and pricing, because you're answering two different questions. So that's the first way to think about dealing with companies where the traditional regressions don't run, is try to find proxies for what people are looking at. So if you're looking at AI, or you're looking at some new medication or drug company, you might want to think about the total market that this company's products can go after, because that's what people are pricing. How close is it to an actual commercial product? Things that investors think about, you're trying to quantify and put into your regression. The second way you can deal with this is to use forward numbers. What are forward numbers? One reason traditional pricing multiples don't work with young companies is there's not much there. You know what I mean, not much there, right? Revenues are small, losses are big. You look at the current financials, book value is non-existent. There's nothing there. But in your discounted cash flow valuation, what happens to your company as you go through into the future, assuming you feel good about the company? Your revenues get bigger, your losses become profits, your invested capital builds up. When you use a forward multiple, rather than look at revenues as a multiple of, enterprise value is a multiple of revenues today, you take enterprise value as a multiple of revenues 5 years from now, 10 years from now. But you've got to be careful. I know a lot of analysts use forward multiples. But there's many a slip between the cup and the lip. So I'll give you an example of how forward multiples get used. An analyst will project out EBITDA 10 years from now, $2 billion. You say a typical company in this sector trades at 20 times EBITDA. 20 times $2 billion is $40 billion. And he will act like that's the value today. What am I missing when I do that? First, that $40 billion is when? 10 years from now. So first thing is the time value of money, right? I've got to bring it back today. What else am I missing? Could some of these companies fail? Yeah, I'm missing the failure rate. During the 10 years, especially if it's a young money-losing company, what are my cash flows going to look like next year, 2 years, 3 years out? Big negative cash flows. I'm missing that. There's a lot of cleaning up to do with forward multiples. In fact, this was a valuation of Tesla in 2013. When you looked at my terminal value, it was $68 billion. The value I ended up with was $8 billion for the company today. People said, how did he get from 68 to $8 billion? So I actually took the $68 billion and I stepped down with each step to show how much you lose as you add each component. So when you bring in, if you just discounted the risk-free rate, pure time value, no risk, it drops from 68 down to 52 billion. You bring in the risk-adjusted cost of capital, the 52 billion becomes 27 billion. I lost another 25 billion. If you bring in the negative cash flows in those first few years, that knocks the value down to 12 billion. You can see with each step how much I'm losing of that value. And by the time you make all of these adjustments, that's why when you look at your terminal values and you say, that's a big number, that's much bigger than my market cap. It should be. But after you made all your adjustments, that intrinsic value you get today will be far smaller. So when you look at these multiples, the scalar, whether you use revenues, earnings, EBITDA, you can take it with any, it doesn't have to be an accounting number. We talked about users, we can talk about subscribers, we can talk about downloads, people visiting your website. You're saying, am I allowed to do that? In pricing, there are no rules, right? You can do whatever you want, and that's part of the problem. I can scale it to whatever I want. So I'll give you an example of this. This was in October of 2013 when Twitter went public. I did a discounted cash flow valuation of Twitter, and then I wanted to do a pricing of Twitter. So I pulled up this, at that time, the social media company. You can see it's a very diverse mix. Netflix is in there. Subscription-based company, got advertising companies. But you're desperate. You're looking for publicly traded companies. I pulled all those companies. I got their market cap and enterprise value, revenues, EBITDA, net income, all the accounting numbers. And then I also was able to find the number of users in each of these. Okay. So the question is, which is the best pricing multiple to use? So I computed EV to EBITDA, EV to revenues, price earnings ratios if they're available. And you can see with P ratios, it's going to be very quickly non-usable. And I divided enterprise value by number of users. Very, very unsophisticated proxy. And then I did a correlation, because ultimately, how do you decide what the market's looking at? You look at what is best correlated with the differences across companies. Go down the first column, there it is. And it's obviously market cap and enterprise value are very highly correlated. They're pretty much the same number. But you look across the four variables, the highest correlation of the number of users. Remember I said in pricing, you respect the data. You entered the pricing domain. You might want to think in terms of revenues and EBITDA and EBIT and book value, but the market's saying we care about nothing but users. You go back to the previous page, the median enterprise value per user is about $100. So let's say my job as a banker was to price Twitter for its offering. Let's face it, that's really my job as a banker. I could have done this, dance around a DCF valuation, but what the heck am I looking at a DCF valuation for? How would I have priced Twitter in 2013? They had about 240 million users at the time of their IPO. To finish the thought, what's the pricing that you'd attach? $100 per user times 240 is 24 billion. It worked out about $45 per share, which might have been pure coincidence, but that's exactly where they went public. Of course, there were adjustments afterwards, but sometimes when you're sitting there trying to beat yourself up saying, I can't get my DCF to explain what the market is paying, you're trying to do the wrong thing. The market is pricing things, and especially in sectors like that, that pricing can be very different from intrinsic valuation. David?
I think Kathy Woods comes out like about every month saying Bitcoin's going to 2 million. Is that sort of the same?
With Bitcoin, even worse. What do you scale it to, right? It's not a cash flow generating company. I think she just makes up crap, to be quite honest, especially with Bitcoin. Right? There's really no economic analysis you can do to tell me where Bitcoin is going. So unless she has this, maybe she's put something to track all the craziest Bitcoin buyers in the world, and she's tracking. But Bitcoin scaling even doesn't work because it's not a business. So much of what Kathy says, I would just ignore from a valuation perspective. I'll tell you what she's good at. She's good at getting trends in society ahead of the game, right? So she got into DocuComp well before all our documents, every document I've signed over the last 2 years has been online with DocuComp. I've not signed a physical document yet. So she gets on trends ahead of people. And that's really where her strength stops, right? Everything else is just pure noise. So I think that with pricing, people base it on something. You might not agree with it, but that often drives where the market is going. I would track AI because I don't see yet the metric that is driving AI pricing. But there will be a metric sooner or later as they get to be more AI companies. You're trying to pick between them. And it'll be interesting to see what that metric is, because early on it's going to be a very, very rough metric, just like website visitors. It'll evolve over time. No, but early on, that's exactly what you should expect to see. So I said, if you can control for differences in growth, yes, go ahead, Fiona.
I have a quick question
Yep.
on like the number of users, because for Twitter there are a lot of like a fake account, like a robot account.
So tell me how you'd make this. So this was 2013, right? People just thought about users as users. By 2017 and 18, you were worried about bot users, fake users. So you might add a column for real users versus fake users, if you can get that information. Remember though, the pricing has to be based on something you can observe. But you also would have added a column for how long do people spend on, so user intensity. So as sectors age, you see people move from very rough scalars to more refined scalars because they learn from their mistakes. The way that usually shows up is some company with a lot of users ends up crashing and burning, and they say, what did I miss here? It turns out that most of the users were fake. And you say, okay, I should focus only on the users that I can count on. So you can already see this evolution in the social media business. Nobody uses EV to user anymore because we've realized how much noise there is in that. And that's why I said in AI, it'll be interesting to see the metric evolve over time, because people are struggling with what is that scaling metric that I can use to compare an ARM to NVIDIA, right? Which are the two large. I can't even think about what I would use other than revenues. But basically, you can already see them struggling with young AI companies, which have very little to show other than a lot of potential. Now, if I can control for differences in cash flows, growth, and risk, I'm no longer constrained to stay with a sector. I can compare stocks across the entire market. What do I gain by doing it? Much larger sample size, right? From a statistical standpoint, it's better to have a regression with 2,000 companies than 100. So at the start of every year, here's what I do. I told you I computed the multiple for every publicly traded company. I also compute the beta, the growth, the payout, all the fundamental variables. And then I'd run market-wide regressions. I used to do this just with US stocks. Now I do it with global stocks. You're saying, what does that even mean? If you take the price-earnings ratio for every publicly traded US stock that has a price-earnings ratio, because remember, money-losing companies don't, and you wanted to explain differences in PE ratios across all US stocks, you could do it, right, statistically? So the first thing I wanted to see was, how good is this regression going to be? And let's face it, the variable that best explains PE is growth. So I started by running a scatter plot of PE versus growth. Already, I know I shouldn't set my expectations too high on this regression, right? I mean, the points are not on this nice line, they're all over the place, which is what you should expect. You have 2,000 companies, who knows what's driving the PE ratio. Undaunted, I said, I'm going to run the regression anyway, and I was actually pleasantly surprised with the R squared. I got a 33% R squared, which is not bad. A third of the variation in PE ratios across companies I can explain. I'll talk a little bit about what's a good R squared, because that's often what I think statistics classes leave unanswered. I'm going to talk about how you can measure that in terms of your predictions, but that's my R squared. The three variables I used were beta, payout, and expected growth. Where did I get those three variables? If you remember, when I did the intrinsic value version of the PE, these are the three that showed up. This is not a kitchen sink regression. You know what kitchen sink regression is? We've all been guilty of it in statistics classes. What's the end game in a kitchen sink regression? To get the highest R squared you can. So what do you throw in there? Anything that increases the R squared. So if the weight of the CEO thrown in increases the R squared, so how heavy is your CEO? I don't want to go there, because I want to price things based on what should matter, and I'm going to stop with these three. First, tell me whether the signs are in the right direction. Growth, every 1% increase in growth increases my PE by 0.7. Does that make sense? High growth companies have higher PE ratios. The T statistic is obviously very significant. So clearly, right sign of the coefficient. Payout ratio, holding all else constant. If I increase the payout ratio, my PE ratio should go up. Makes sense again. T statistic is significant. But beta, I have a problem, right? Holding all else constant, as my risk goes up, what should happen to my PE? It should go down. But here it's actually going up. And there's a good reason for it. And I'm going to talk about this because it's a statistical problem that I haven't faced up to. Okay? But that overall regression is a predictive regression, but these are the three problems that are embedded in the regression. A couple are fixable with statistical tools. One is beyond fixing. One is, this is called a linear regression. What a linear regression does is as the independent variable changes, the PE ratio changes proportionately. And we might be living in a nonlinear world whereas growth changes that's fixable. In fact, if you use a statistics program, that actually allows you to run what's called a nonlinear regression. Now, the reason I'm not going to go there is this is not a statistics class. We could if this were a statistics class, we could just take this regression and spend the rest of the semester finessing the regression. It's fixable, nonlinearity. Second is non-stationarity. What does that mean? I run this regression once every year, at the start of every year. My 2024 regression doesn't look remotely like my 2023 regression in terms of the coefficients. Sometimes the coefficients even change signs. Does that bother me? No. At that point in time, this is the best predictor, but it's shifting over time. You can't take a 2018 regression and use it in 2024. You might not even be able to use a 2023 regression in 2024. You might not even be able to use the 2024 regression the further you go into the year. You're saying, what the heck do I do? Run your own regression, right? It's not like I did something that you could not do. You have capital IQ. You can update the regression. And thirdly, there's this word that you hear in statistics classes when you say, what the heck is that? It's called multicollinearity. You remember your statistics class when you run a multiple regression, what's supposed to be true about your independent variables if it's a good multiple regression? They're supposed to be uncorrelated with each other. What are the three variables I have in this regression? Growth, payout, and risk. Is there any universe where those three things are not going to be correlated? High growth companies, fill it out, are more likely to be lower payout and higher risk, right? It's a feature, not a bug. In fact, you can see that when you look at the correlation matrix, but let's talk a little bit about that when we get to the correlation matrix. The other thing I want to note is when you run this regression, don't feel entitled to get t-statistics that back you up. You know what I mean by that, right? You're saying, in theory, these are the variables that matter. The market doesn't care about your theory. It's going to do whatever it wants. So if you have variables with insignificant t-statistics, the best thing to do is remove them. I mean, the standard of t-statistics above 2 is a decent one to go with. I'm not completely embedded in there. If you have 1.8 and you want to leave in there, that's okay. But 0.2 t-statistics, better to take it out. And finally, and this is again a statistical problem that becomes a problem for us in predictions. When you run a standard regression, the intercept can be negative. What does that mean? Nothing really. It's just because remember it's fitting a best fit line. If the line has enough of an angle to it, you're saying so what? If you have a negative intercept and you try to use that regression to make predictions on PE ratio, you can end up with a negative PE ratio. For a company, the intercept is negative enough. You're saying, can I just make the negative into a positive? No, that doesn't work. But if you have a statistics package, usually many of them, almost every one of them, will give, including Excel, will give you a choice of running the regression through the intercept, letting the constant be 0. When I have a regression with a big enough negative intercept that I'm worried, I just rerun the regression. Statistically, you're losing some power because you're tilting the line, right? Instead of finding the best fit line. But in return, you get a 0 intercept and the R-squares that will get reported will be huge, will be great, but they're deceptive. The R-square that matters is the one that you got with the original best fit line. So let's talk about the multicollinearity problem. So I took the PE, beta, payout, growth. So let's focus on beta, payout, and growth, and focus on this part of the correlation matrix. If this were a perfect regression, you should see the 1s on the diagonal and 0s everywhere else, right? But that's not what you see. If you take payout ratios, negatively correlated with growth. High growth companies have much lower payout ratios. If you look at growth and beta, high growth companies tend to have higher risk. Your intuition kind of led you there, but you can see it reinforced here. You say, so what? What does a computer see when you run a regression? It doesn't see beta, growth, payout. It sees 4 columns of numbers, right? You call one column beta, the next column growth. The computer couldn't care less what you called it. Let's say most high growth companies have high betas and most low growth companies have low betas. After a while, the computer gets confused about what beta is measuring. Beta becomes a better proxy for growth than for risk. That's exactly why you saw that positive coefficient. You're saying, what do I do about it? Nothing you can do about it. How are you going to find a measure of risk that's not correlated with growth and payout? But I have some good news. You can still use the overall regression. The predictive power holds for the overall regression. What you cannot do is take the individual coefficients and try to build elaborate models about why the coefficients are what they are. Because there's that the correlation is making those coefficients difficult to read. Now, the advantage of a market-wide regression is you can use it to price any company in the market. So as an example, let's suppose I wanted to price Disney and I gave you a growth rate of 15%, a beta of 0.9, and a 20% payout ratio. I have the regression for the entire market, right? You plug in Disney's beta, Disney's growth rate, Disney's payout ratio. I get a predicted PE of 29.8 times earnings. The time I did this, Disney was trading at 74.7 times earnings. You don't even need to do any statistical tests. But here's where the R-squared comes in. When you get a predicted value from a regression, if you have a good statistics package, you can also get a range on that prediction. It'll tell you, do you want the 10th and the 90th percentile? If your R-squared is 100%, what will that range look like? There'll be none. It'll be a perfect prediction. The lower the R-squared becomes, the bigger the range becomes. Indirectly, I'm answering the question, what's a good R-squared? There's no such thing. A low R-squared just makes your prediction noisier, a bigger range, which makes it less likely that you'll find your company to be cheap or expensive because the range becomes really big. The higher R-squared, the tighter the range becomes, the more likely it is that you will find mispricing in a company. So let the data drive you here. Don't try to make the data do what you'd like it to do. You want a high R-squared, you want a great prediction. It's not in your control. It's what the market specifies. So when you look at, that pricing Disney, this will lead you to believe that Disney is overpriced against the market. Could I have priced Disney against entertainment companies? What would I have done differently? My peer group would be entertainment companies and run a regression against those. Is it possible for something to be overpriced against the market and underpriced against? I know we're adding layers of mess here. Can something be overpriced against the market and underpriced against its sector?
Yeah.
Absolutely. In fact, if I take the Amazon regression I showed you in 2000, run that regression against the market, not just against internet stocks, I'd have gone back to my original, it looks overpriced. You say, then how do I decide? You framed the story, right? And this is why you have to be careful when somebody says, this is cheap, this is expensive, because what do you need to ask them? Compared to what? Right? Because that, even in pricing, you can see that makes a big difference. Now the coefficient I showed you for growth on that regression, remember I described equity risk premiums as the price of risk in the equity market? You can think of the coefficient on growth as the price for growth that the market is willing to pay. So if you're a high growth, high risk company, what's your best case scenario? You want the market to pay a high price for growth and charge you almost nothing for risk, right? Low equity, that was 2000 right there. Equity risk premium of 2.05%, market's paying 2.1 times the growth rate. You were in nirvana as a young. You could be the same company 1 year later, take a look at what happened. Equity risk premium, in 2002, equity risk premium almost doubled. The price paid for risk had halved. The same company, repriced, is now going to have a much lower pricing. And I'm stating the obvious, but if you're a high growth, high risk company, how you do in the future is very much a function of how the price of risk and price of growth vary across time. So I do this with price of growth once a year, but you could potentially, if this was your life, is to run a portfolio, you could think about updating this so you can get a sense of what's the market paying for growth and what is it charging for risk, because that joint effect is what's going to determine which companies are going to do well and which are going to do badly. peg ratios. Try this on peg ratios. The first thing I did, I wouldn't run a regression against